Hi, this is James Robinson, and this is part 2 of my series of videos on the stock The Child's Place, symbol PLCE. Typically, my second video about a stock is a deep dive into the company's operations. However, in this case, I'm not really buying the company because of its operations. In fact, the operations are something that would keep me from buying it. So this time, our second video is going to be on wealth creation, which is how good a job management does of returning wealth and money to the shareholders. Before we go any further, I'd like to ask people who view this to do me a brief favor. Obviously, I'd love it if you subscribe or like the video, but I'm very curious about who's watching these videos and where people are from. So if you don't mind, just in the comments below, just quickly write down, where you're watching this from. I'm kind of getting a sense that people are watching this from all over the world. That's kind of cool for a guy who's spending all his time making these videos to see people are watching it, not just from the States, from everywhere. So I'm from Phoenix. Wherever you're from, just write down, Moscow, Russia, or Bangladesh, or wherever you're from. I'd be curious to know. Thank you very much. So one of the first things a company can do to create wealth for its shareholders is to buy back stock. What that does is it means that without spending any of your money as an investor, you own a larger and larger piece of the company every year. That means that if the company eventually sells, you get a higher value, a higher percentage of that money. It also means that you get a higher percentage of any earnings that come in. The earnings per share will increase, which likely will make the stock price increase. So while there's a corresponding reduction in the amount of cash we have on hand because we're using that money to buy stocks, it's a tax-advantaged way to create wealth for shareholders. And so it's something we really look forward to. And if you look at this stock, you can see that since 2008, this company has bought back shares basically every year. Most years they bought back north of 1 million shares of stock. And that's had a significant impact on the ownership of the company. And is one of the things that I think really makes this company a great company. In terms of quantifying the amount of stock that has been bought back, if you'd owned 10% of Children's Place stock at the end of 2008, you would have owned about 2.9 million shares of stock. Today, through stock repurchases, those same 2.9 million shares of stock would mean your ownership in the company has increased from 10% to 17.7%. So that means you've increased your ownership stake in the company by 77%, and that's without spending a penny, without paying taxes on any of that gain. Again, looked at another way, your share of the company earnings would have gone from $8.84 million, that's 10% of the profits in 2008, to $17.98 million, which is 17% of the stock today over those 10 years. That's an increase of 102%. And then another way of looking at it is that your earnings per share would have gone from $3.01 to $6.10. And again, assuming that the PE was the same, you'd have seen the stock price double over that period of time. One measure of how a company is doing is its shareholders' equity. That's simply assets that the company has minus debt. Now, in this case, the company has no debt. So what you're seeing here is something that at first blush, the shareholders' equity has gone down since 2011. And at first blush, that might turn out, you might look at that and say, that's negative, we have less assets. And we do. The company's returned significant amounts of money to the shareholders over that time through dividends and through share repurchases, etc. But the good news is, even though they're utilizing less assets, they're making more money. So the company is getting more and more efficient. So while it's counterintuitive to say a reduction in shareholders' equity is a good thing, in this case it is, because there's less equity and more profits. So it's very efficient. We really like that a lot. Another way of looking at this is to figure out how good the company is relative to other companies at getting a return on assets. So every company has to tie up a certain amount of money for its operations. That is just part of the business. We understand that. The old adage, it takes money to make money. However, since 2013, this company has had an increasing return on assets. In 2010, it was about 7%, and return on assets. Today, it's almost 15%, so that's almost a doubling of return on assets. And the company has gone from just outside the top 25% of companies that I've looked at to north of the top 10% of companies that I've looked at. So it's getting more and more efficient, and it's getting more and more efficient relative to other companies that in the universe that I might look at. This is a fantastic thing. One of the really important things that I look at a company is return on assets, and this company is excellent and is getting better. One of the areas my companies tend to fall short on is return on equity. Again, the difference between return on assets and return on equity is that equity considers debt in the equation. If a company has $100 million in value and $50 million of debt, $100 million of assets, and $50 million in debt, then the equity for the company would be $50 million. And so the return on assets, if it made $10 million on $100 million of assets, would be 10%, but the return on equity would be 20% because it has only $50 million of equity. My companies tend to have significantly less debt than the average company, and so we tend to perform less well than the universe of companies in terms of return on equity. That's not the case with this company. Since 2013, again, the return on equity has gotten better every year, and last year for the first time it was in the top 10% of return on equity, and it's doing that with no debt. That's spectacular. That's a really, really exciting statistic. And it's one of the reasons why I'm really surprised this stock has dropped as much as it has. I think this stock is a fantastic buy. So often a company has to retain some portion of its earnings every year in ongoing operations to replace worn out products, to increase inventory, whatever it might be. This company, since 2011, has not had to retain any earnings. In fact, it's given back a net of the earnings that it's made. That's why you saw the reduction in equity. The company has found a way to create the same and more profits, even though it has retained effectively negative earnings. Again, that's spectacular. No companies have negative earnings and see their profits grow. This is just an exceptionally well-run and well-managed business. One of the things that I always talk about is return on retained earnings. What I'm looking for is, I don't mind if a company retains my money, but I want to make sure that they're using that money efficiently and effectively. So I usually have a chart that shows you how that's happening, and sort of the goal is to get a return on retained earnings north of 10%. In this case, I don't have that chart because the chart starts to get goofy when you have negative retained earnings and positive earnings growth. You have negatives and positives, and the chart just doesn't make any sense. So just trust me, it's spectacular. It would be easily in the top 10% of companies for return on retained earnings. We love the fact that this company is retaining negative earnings and increasing its profits. It's never done. So one of the things that I look at is total wealth created, and I define that it's my own sort of statistic that I look at. So I look at a company as having a number of ways of returning wealth to the shareholders. One way that it can do that is by reducing debt. When a company pays down debt, the value of the company goes up proportionately. And it also goes up slightly disproportionately because when a company reduces debt, they reduce their interest payments typically. And when they reduce interest payments, that increases profits. When you increase profits, when you have a multiple of profits for a PE ratio, you can see an increase in the stock price. So, and in addition to that, the company has what I call debt reserves, money that it could borrow if it needed to, that are enhanced by the fact that it's paid off debt. So it makes the company more and more able to withstand a recession, and to the point where the company gets no debt. Then it's really in a position to really outperform its rivals, many of whom will go out of business if they're debt laden in a recession. So changing in debt is something that we really look forward to, really look for in a company. This company has no debt, so it doesn't really apply. The next thing a company can do is increase cash. When a company increases cash, it has the ability to invest that cash and maybe get some return on equity. It also means the company is more likely to be able to borrow money in the future. It has better reserves to do things that it needs to, and obviously just cash shows up on the books as a net gain. This company actually has had a reduction of cash of $75 million over the last few years. It has had that because they used $75 million of their own money to buy the Gymboree brand. And we're going to talk more about that later, but effectively, even though this company parted with $75 million, it still had significant increases in wealth. And we're going to talk as we go on with this slide. Next thing a company can do with its wealth to create wealth for shareholders is pay dividends. You can see this company pays us a little bit of money to dividends every year, and that number has increased. We'll talk about that on a future slide, but the dividends for this company are good. Another thing the company can do is buy back stock, which is where this company has tended to focus most of its energies, most of its effort, and you can see that the stock purchases have been solid, over 1 million shares a year, and that's a wonderful sign. So the blue or turquoise line is the annual wealth created that year. That's sort of the summation of all of those numbers. But I don't really look at that 1 year chart because weird things can happen on a year-to-year basis. What I do is I average the last 5 years of those numbers and say, what's the company done over the longer run in terms of wealth creation? And you can see that this company has done fantastic over each of those 5 year periods, which is that orange line. It just keeps going up, and so it's wonderful. We really like this stock. We think that the wealth created by this company is fantastic. And while we're going to do a video later on the operations, and you're not going to love the operations of this company, the wealth creation of this company, the fact this company takes what profits it can generate, does such a good job of getting that wealth back into the owner's hands, is the real reason I'm telling you that you should buy this stock. When we talk about wealth creation, I always talk about how our little portfolio is doing. If you had followed my advice from February 7th of 2019 when I started giving advice on stocks, these are the companies that I purchased. That's the date that I purchased it, the date that I sold it, how many days I owned it, and the return on the annualized return and profits that we made after owning it. And so these are every one of the stocks. You can go back and watch every one of the videos and see that the date I put here is the date that I said we should buy it. But I'm pretty happy. All of these stocks have done very, very well. And in fact, none of the stocks that I have sold to date have had a loss. I will sell a stock that has a loss, and we'll talk about that on the next slide, but not significant and not nearly enough to offset all these gains. So I'm pretty proud of these results. What you can do is pause this, and you can spend some time looking at, how much we made off Phillips 66 or Apple or Martin Transport or whatever it is you want to look at. There's no reason for me to go over it. I tend to do that in most slides. And I'm going to do a year-end review where I'm going to spend more time on that in the next few days. One other note that I'd like to make is I don't tend to post videos when I sell a stock, and I don't post them immediately when I buy a stock. It takes time to make these videos, and it takes time to edit them. So if you want real-time information on what I'm buying and selling, you can feel free to follow me on Twitter. My handle is at Robinson Stocks. Also, I will, if I see an article that's interesting or other pieces of news, I'll also tend to put information on Twitter. I don't do a lot of posting. I'm not a daily guy. But a couple of times a month, I'll put something on there that I think is interesting. The next slide is my current portfolio as it stands today. These are, again, videos that I suggested you should buy going back to February of this year. This does not include the stocks that we have sold out of. This is our current holdings. And again, spend some time on look at this if you want to, but I'm going to do a special video on year-end results in the next few weeks, in the next few days, I should say. The one thing that I should tell you is that I'm almost certainly going to sell Argan in the next few days. I'm not doing that because I've lost faith in Argan. I'm doing that because I currently have an 11% loss in the stock, and I'd like to offset that against other capital gains. So while I'm not really neither hot nor cold on Argan, I'd rather have the 11% offset and go find some other stock, or maybe we'll buy Argan back in a few months.